Hey guys, welcome to Stock Talk with Nico Criticos. Today we're going to be going through the 7 stocks that I am buying in the month of May. All of these companies I already have positions in. Some of them are small, some of them are large, but I'm going to show you what my cost basis is and what my thoughts are with these stocks going forward. So the first one on my list here is going to be Mastercard. And now keep in mind, I also own Visa. That one's not on the list because Visa I've owned for a while. Mastercard I just started making a position in. And as you can see, it's a pretty small position. I only bought 3 shares right now. The reason being that I don't think the stock is at some super attractive valuation or something. I just really love these business models, and I just am really confident in the Visa and Mastercard business model. So I just really want to be a shareholder of this. And the stock is down a little bit from its highs. So I feel like I'm not getting a horrible price. I don't think I'm terribly overpaying. I mean, if we come down to the P/E ratio here, we can see the forward PE over the last year plus has been anywhere from a 27 up to a 33, and I'm paying about 31. So I'm pretty much paying the average. I'm not getting a great deal, but I'm not, horribly overpaying or anything. So that's why I kind of have a pretty small position in this. And if the stock keeps falling, or if the forward PE gets smaller, well then I'll buy more shares. But I just really love these companies, and I really want to be a shareholder because I'm really confident in them. So the next one on my list is going to be Adobe. This one I've owned for a while as well. I believe my position in this is a lot larger. This one I have 8 shares at $506 a share. Again, did I get in at some phenomenal price? Did I buy at the bottom? No, but that's because I actually bought this one 2 years ago, sold it, I believe, late last year, and made a pretty good profit because I think it went, let's see. I originally picked the stock out when it bottomed over here at $287. And then I sold like somewhere around here at like 500 or 450. I think probably 450 or 500. So I already made some money in this little bull run right here. And then now that it's dipped again, I'm ready to start buying. And really this stock has been, we're about to have this stock be flat for the last 12 months. So that's also a good sign. Adobe is one of the best things about this company right now is I feel like their profitability is gonna go way up because of artificial intelligence and the way that you could integrate artificial intelligence into all their different softwares and programs. So I'm really happy to be a shareholder of this one too. This is another one where I'm pretty confident because it's like this one is one of those stocks where you always see hedge funds and just the billionaires putting money into this company. So that's just another reason to be bullish. Now, as for the valuation, this one's kind of weird because if you look up on, first of all, this stock always trades at a high valuation. Okay. So keep that in mind. Like we're talking 40, 50, 60 times earnings. But on Yahoo Finance, it's going to say the forward PE is, I believe, like a 30. I think it's a 30 or 30 something. But the thing is, if we look up the history, so no, forward PE of 27. See, so we're actually getting a pretty good deal. 27 is not that bad. If we look up Adobe here on macrotrends.net, it makes it look like now keep in mind, this is the trailing PE, but still, the trailing PE is 46. And this website makes it look like it's like 60 or something. So that's where I'm a little bit confused with that. I'm not sure why those numbers are so different because normally when I compare those two websites, the numbers are fine. Now, here's number 3. Number 3 is going to be Cadence Design Systems. This stock I own in my other Fidelity account. So this one I'm not going to show you my position, but I believe I have about $3,000 worth. This is another one where I just bought this a couple of weeks ago, and I really love their consistency. I really love their growth. I really love the industry they're in. I really love their return on capital numbers. I mean, just a kind of like an overlooking thing with all these companies and just my strategy investing is I like to have companies that are very consistent with net income and revenue growth. Like we're talking, at least 5 years, if not 10 plus, 20 plus years. I want a bunch of years of consistent growth. And I want a good balance sheet that does not have negative equity or a bunch of debt. I want high return on capital numbers of probably at least 20%, but honestly, I found enough that are 35, 40%. So those are really high quality companies are the ones that can get 40% return on capital. But those are the main things. And so that's kind of just to preface this. Now, one of these stocks is actually kind of weak with those metrics, and I'm going to talk about that. But that's generally what I'm looking for. So Cadence Design Systems, the description here says they engage in the design and development of integrated circuits and electronic devices. So that gives you an idea what they do. This company also trades in extremely high valuations, 73 times trailing earnings right now. But again, high ROI, super good, consistent growth. That's why I like it. And I'm super bullish on the semiconductor industry for the foreseeable future. And that's why I'm happy to be buying this. Then we have Ulta Beauty. This one's also in my other account, so I can't show you this. Now this, I believe this one I also have about $3,000 or $3,500 worth, I believe. And both of those I bought in the last couple of weeks. I'm probably down 5%, 8%, something like that. So okay, Ulta Beauty is still falling. Ulta Beauty has not found its bottom yet, but that's okay because that means this is a great opportunity to be buying. So see, the last two times it bottomed at 382 and at 371. So I have a feeling we're close because this stock is struggling right now because inflation and consumer demand and all that stuff. So, which a lot of companies in this retail space are having that issue. But Ulta Beauty is the #1 beauty retailer in the United States. I think people spending money on beauty products is always going to be a strong industry. That's why I'm happy to be a buyer of this one. And as for the valuation, let's take a look at the valuation. At this point, it's been falling for, let's see. I mean, it's at a 52-week low. Well, is it? Let's see. It's almost at a 52-week low, but it's been falling for what, at least 3 months now. So it's got to be getting down there in price. But we're looking at, let's see, will it show us? Will it show us? We're looking at forward P of 14, right? And it's traded at a 14 to 22 the last year and a half. Okay, so I'm happy paying 15 times earnings for this company. Again, this year they might be struggling, but they will come back. Okay, this year they're expected to do $26 EPS, not much growth, but then next year $29 EPS. So I'm confident with this one. This one will come back. This one will be over $500 again, and I'm happy to be a shareholder of that. Okay, next up on the list we have Starbucks. This is the one that I'm most ready to get rid of because if you watch my videos, you probably have seen me talking about buying this stock now for quite a while. It's probably been 6 months or so since I've been buying this stock because pretty much when it went below $100, I started buying. So yeah, I probably made a position in maybe even probably last year, really. But now my position has gotten really big because with the stock dropping recently, I had to buy more shares to lower my cost basis, and now I'm just kind of waiting to get back to baseline. So I'm down 20% on this. This is one of my worst investments right now. I'm down 20%, 52 shares at $91 a share. So I got what, a little bit over $4,500, almost 5,000, I guess. But I mean, so I love Starbucks. There's so many things I love about Starbucks. I love the customer loyalty. I love the products they sell. I love how many locations they have. I love, first of all, I love drinking their coffee. So that's another thing. But I could see why they're having trouble growing. Okay, how I said, they have almost 40,000 locations, which is insane. They're pretty much on every street. The other problem this year specifically is the competition with other drinks, beverages, and specifically caffeine drinks, because you always have Dunkin', right? But Dunkin' has come out with different sort of like energy style drink things, and then you have McDonald's opening. McDonald's has also competed because they opened that Cosmix. You have Panera, you have all these different energy drinks. There's a lot of competition now because these companies are realizing how much money, how addicted these people, how addicted people are to these caffeine products, me being one of them. And so that's where I think Starbucks is kind of struggling. The other thing you could argue that's probably a good factor in this is the prices and the inflation and the economic position we're in right now. People are probably cutting back, which I believe they said in the earnings call. I think the CEO said the occasional customer is the one that is not coming back as much. And that's where their kind of their growth disappeared. I believe the strong loyalty customers, those customers are not the problem. But it's loyalty, it's returning customers, and it's also are they starting to charge too much because they're always raising prices, right? And normally they're pretty good with pricing power. Normally they raise prices and it's not a problem. People still go back. So maybe this will kind of teach them a lesson. I can tell you what I did not like. Well, there's two things I don't like. One is the balance sheet. They have a bunch of negative equity and a lot of debt. Okay, bad balance sheet. I don't like that. And then the second thing is I watched an interview with the CEO and I didn't get a good feeling from him. He was not talking how he wasn't reacting and giving guidance like he should have probably. I don't really like the way he was describing things. I don't really like his take on the situation and what his thoughts were on it. So that's the only thing. I didn't really love that. But at the same time, I mean, look at the last 5 years. This stock had a strong bottom at $71 in 2020 and at 2022. So this is probably the bottom. Okay, this is probably the bottom. And there's a really good chance this stock is $100 again 6 months from now. Okay, so I guess I'm gonna have to wait. But really, I would like to get rid of this, at least sell at least half my shares because I do not like that balance sheet that they have, and I don't. I can understand why this company's not it's gonna have trouble growing. It's gonna struggle to grow. So that's the only thing. I mean, I love seeing the bullish thing about Starbucks is that they have a bunch of lines going out the door. There's a bunch of people waiting in line through the drive-throughs and everything. That's the good part. But I guess that wasn't enough for this past quarter because of the competition and the prices and all that stuff. All right, enough with that stock. Let's move on to Lululemon. I believe I started buying this about a month ago, probably. I think most people know what Lululemon is. They're a kind of a fashionable leisure wear, exercise wear sort of clothing line. This one I got 11 shares, a little bit over $4,000 into it. I'm down 8% right now. And this is another one, extraordinary return on capital numbers. They got the growth in there. They're probably struggling with consumer demand and inflation problems right now, like most other retailers. But again, I am confident they will come back. This stock normally trades at a very high valuation, so you're not going to get this at a super cheap deal. But so they are supposed to grow this year, $14 EPS, and then almost 16 the following year. 12% revenue growth, 10% revenue growth. Let's look at the forward PE. We got 25 forward PE, when in the past it's normally trading at 28 to 32. Okay, so I'm happy with this one. This is at another almost a 52-week low. And I mean, look at the last 5 years. It's trading at the same price as it was 4 years ago. So, and look at the growth they've done since then. So I just like it. I like companies that have good financials, that are very profitable, that have really high return on capital numbers. And companies like this, again, they show consistent growth. Let's look at their numbers. Okay. The last 5 years, they've averaged 26% net income growth per year. Okay. In 2020, they did $480 million in net income. Next year, $588 million. Last year, they did 1.5. So they tripled their net income, and the stock is at the same price it was. That makes no sense. That means this stock is probably going to go back to $450 at least, if not probably $500. So that's the way I look at this. This stock is now flat for the last 4 years. That doesn't add up because they still have growth coming. They're gonna do more this year and more next year, and their numbers are extraordinary. So it's like I don't see why this stock wouldn't be over $500 then. Now, if you say, well, okay, people don't want to buy their products anymore, maybe they're switching to another brand, that's possible, but I'm not seeing that happen yet. They're giving out guidance that they're supposed to grow 12 and 10%. So I'm not seeing that. Okay, last one on the list. This one I bought a couple weeks ago, Monster Energy drink. I might have owned this at some point in the past. I can't remember, but talk about consistency and customer loyalty and an addictive product. That would be Monster Energy drink. Down 9% on the year. Okay. We're looking at now. Here's the other thing to see too. I only have 20 shares. Again, I don't think this stock is at it's not at the greatest price. I'm not saying it's undervalued. So that's why I only put $1,000 in this right now. I just really want to be a shareholder of this, and I hope that the stock comes down so that way I can make a bigger position. Let's see. Okay, forward PE of 29. Look at the consistency with revenue. 2014, they did 2.5 billion, 7.5 billion. In 10 years, in 9 years, they went from 2.4 billion to 7 billion of revenue. Net income, 10 years ago, 480 million. Last year, 1.6. That's a 4x in net income in 9 years. Okay. Look at the cash on the balance sheet. 3.2 billion in cash, 0 debt. Okay. Let's see the ratios. 22% ROI, 22%. And that's on the low side. A couple of years ago, they were doing 32%. That's what I like to see. Okay. Now, I would also be curious to see, let's look up what the history of this PE ratio is. I try to buy it. If the PE ratio jumps all over like crazy, then it's hard to value that stock. But if the PE ratio is typically in the same short range of numbers, then it's easy to value the stock. This one looks like it's in the same range, so this one should be easier to value. Well, maybe not. Now that we zoom up, we're looking at a range of 27 up to 45. That means it could trade in a lot of different places. Right now, we're like right in the middle, though. We're at 34. So I guess, okay, so you almost got you got like a 50-50 chance almost. It kind of looks like this stock could trade at 45 times or it could trade at 25. So that's why I wouldn't go, I'm not going too crazy on the position size right now, but I'll probably slowly start building it out over the next couple months, especially depending on what the stock price does and what their earnings growth is looking like. But let's see what their growth is expected to be. It's honestly amazing how this company has consistently grown the way they have over the last 20 years. People still drink Monster. All right, so we got 1.5, 1.82, $2 EPS, 10% revenue growth this year and next. That's good enough for me. That's good enough for me. So I'm happy buying this. So we're looking at, let's see. Yeah, forward PE basis of what I say, 26 or something. No, 30. This one says 30. Okay, so those are my 7 stock picks. Thank you for watching, and I will see you guys in the next video.